Today we are going over why we are seeing crazy high mortgage rates, increase in unsold inventory, but housing prices not dropping as much as you would expect. Let's get into it. To start, we have to look back in the past to gauge the future. And we are going to look at the 2008 financial crisis. In 2008, we saw national home prices fall by 27%. 27%. $1 million home is now worth less than $750,000, right? So let's look at today. So it was, of course, different, right? History repeats itself, but when it comes to economics, we can learn and we can move past it. So 2008, 2009 was different, right? We saw prices fall from a push from sellers. Sellers were willing to take a loss on their home, right? They were willing to sell their once $1 million home for $750,000. Now, why is that different from today? We will get into that in a little bit. So, how low can it go? All right, a 27% drop. Are we going to see that again? So, we see Tucker right here saying, anywhere, I would be surprised to see prices anywhere drop below where they were in 2019. In 2019, they were 274K. 274K was the median price of an existing home. Now, where are they today? Today we are sitting at 384,000 for the median sales price of existing homes. They peaked at 413 after this insane run up from the end of 2022, the end of 2021, start of 2022. So this run up from below 360 to 413, right? And now we are sitting pretty at 384K, which is substantial. It's a 6.6% increase from the November levels. So let's look at some more numbers here, right? We see 7 straight months of incline in median listing price, right? From 370K all the way to almost 500 or 450K, right? 17.8% increase in 7 months. Luckily, we are starting to see this downtrend as we need to. We are only in 3 months of red or median listing price going down, right? As you see, a normal, a stable market was looking in the price range in the 370s. Right? It didn't even move for 3 months straight, actually. And then we see stuff like 17.8% increase in 7 months. So how do we go about this? Right? If we look at the price reduce count, this is how much people reduced or increased their listing after being on the market. So what we see, people would reduce their listing, right? If you have a $500,000 house on the market and it sits there for a couple of days, sits there for a couple of weeks, you're going to reduce it. You're going to want to give people more incentive to buy it. But what's interesting is we start to see this get closer to positive, right? And right around here, we see that switch. When housing prices were skyrocketing, we start to see this switch towards a positive price reduction, where people would actually update their listing and make it more expensive to buy. People would make it more expensive after being on the market. And we actually get close to almost 1%, which means if you put your house on the market, when you put your house on the market, the next price change would be an increase of 1%. And so we are luckily starting to see that go down as we get to. But that is something that needs to go down. We need to see this back in the negatives to get back to a normal market. Now, interest rates and mortgage rates. We are seeing these 7.5% mortgage rates, and it is mainly because of the federal funds interest rate. Mortgage rates play off very much so from the federal funds rate. And as we can see here, we had the Fed expecting a 4.25, a little less than 4.5 interest rate by the end of 2022. Now, this was their last meeting. We do have a meeting coming out in a week that will give us more of a closer, more accurate estimate. But so right now we are at 3.25. We are expecting a 75 basis point increase in the November meeting in a week, which puts us at 4. Now, it's still up in the air whether they are going to do a 50 or 75 basis point increase in December. 50 would put us at 4.5, 75 would put us at 4.75, right? And so that is affecting mortgage rates drastically. Now, if we look at the 2023 one right here, this next one, we see that they're a little less than 5. But as we know, we are having to shift up all these dots as inflation kind of stays and lingers around. So we are expecting a 5, maybe even above a 5, 5.25 federal funds rate, which would really affect the markets and mortgage rates. We could see 8% mortgage rates, which would bring housing down, prices down more, increase inventory, all that good stuff. But as we see here in 2024, it's all over the place, right? They don't know what they want to do. And as we see inflation start to go down, of course, they're going to lay off a little bit, and this should help decrease mortgage rates and hopefully increase housing purchases. Now, what do the experts expect from this next 6 to 12 months? Goldman Sachs expects a decline of 5 to 10%, Wells Fargo 5.5%. So we are kind of in this price range of 364K, 364K to 385K. And we are at 384K right now. So not much of a decrease left in us. And right, we are down actually 7% from the peak hit in June. And so that's kind of in Goldman Sachs' estimate range. So what does that kind of mean for us? Why are housing prices not going down as much as you would think? Well, it's like this. With mortgage rates so high, someone who used to be able to buy a $500,000 home is now priced down to $400,000 and so forth, $400,000 to $300,000. And eventually you get priced out of buying a home at all, right? You can't afford the 20% down payment. You can't afford to pay 7.5% interest rates on your mortgage. So then you go to rent. And we have seen a drastic spike in rents over the last year. And so the home prices don't need to fall because people still have rental inventory. People still have the option to go rent. And so if we see that switch, if we see too many people switching into rent, then we might see more housing prices fall because less people can rent, and then we need to see housing prices fall. But unfortunately, as I will talk about in my next video, is we are in this tale of two recessions where the rich are getting richer, right? All these landlords that were picking up homes cheap in 2020 during peak fear and COVID are now renting them out to these people. And so we have the rich getting richer off raising rental rates. And the poor are now not able to afford a home, not able to purchase assets, and having to pay for these drastic increase in rents. And we should definitely see that catch up to us soon, where the large percent of the population is getting drastically affected by one of their main assets, one of their main reasons to work, their home price. And so we should see that catch up to us, and it's really unfortunate. In my next video, we will dive deep into the tale of two recessions, where the rich get richer and the poor are getting poorer, and it's just a lot more drastic. So what should you do, right? Should you go and invest now? Should we buy and rent out now? Doesn't quite seem like it's time for that either, right? So, mortgage rates are high, but all cash sales accounted for 22% of transactions in September, down from August and down from last year. All right, so even though we have high mortgage rates and therefore cash does not even need to look at mortgage rates. If you pay in all cash, less cash purchasers are stepping in. So that's interesting. Normally cash buyers are investors. As we see here, individual investors purchased 15% of homes in September, down from August, but slightly up from last year. So it doesn't even seem like it's time to purchase an investment property yet. I think we have a couple more months. Even if you're buying all cash, it doesn't seem like the time to buy. And especially if you're taking a mortgage, it doesn't seem like the time to buy. So it seems like waiting is the best option, seeing what you can do, and then potentially purchasing an investment property sometime in the next year. Because if we look back here, um, prices will rebound and rise again in 2024 is expected. So, having something set up by then could be a great option. So, it doesn't look like it's time to sell, doesn't look like it's time to buy. Where does that leave us? I'm currently just stepping back and assessing the situation, learning as much as I can, building as much knowledge, accumulating as much money, and getting ready to strike in the housing market when it's right. If you want to follow along and join me through this process and look into buying your own investment property in the next year or so, let's do that. Let's make money together. And I look forward to seeing all of you again and hopefully one day sending me your investment properties